Hello, sir.
Hello, Kushi.
Welcome back to the podcast.
Thank you very much for inviting again.
Yes. So today's podcast is about transfer pricing.
Okay, interesting topic.
Yes, because I keep working with foreign subsidiaries in the organization. So I realized one thing, that not all foreign subsidiaries who are coming to us, so they are not following the compliances of transfer pricing.
Correct.
So can you explain us what transfer pricing exactly is before we start?
Okay, sure. So transfer pricing is a certain, you can say that, in the good olden days when the foreign companies used to come to India, they will charge or the way they decide a pricing for their goods and services in India, and then they don't pay taxes to the government. So what government said is everything has to be an arm's length transaction. Now either if someone who's coming to India should buy and sell in a certain manner, which is called arm's length transaction, or if you are using India for cheap labor, or you call a back office, which is like GCC centers, then in that case they will say that the type of activity you are involved, based on that we will decide a pricing. So that's called transfer pricing. So whether it is for purchase or sale, both cases you need to have a transfer pricing.
So are there any benchmarks by the department?
Absolutely. So Income Tax Department has decided benchmarking through safe harbor route. So you fall in that category of a software services or a goods purchase, then you say that I fall in that category, and you identify your category and there is a rate given to it. So you identify that rate and charge on your clause plus markup model.
Okay. Okay, thank you for that, sir. But again, the customers that comes to us, they are missing out this transfer pricing audit.
Correct.
So is there any eligibility criteria, or for all foreign subsidiaries is this applicable?
No, this is applicable for all, because TP audit is on the rate deciding. So it's not that I'm eligible or not eligible. The time you are doing a transaction with an entity in India, whether it is your own entity which you have formed, TP is applicable. Transfer pricing is called TP also.
Okay. So how do you suggest that founders right now who are getting into foreign subsidiaries and getting new startups, they don't miss out on this very important compliance that we have to follow?
Yeah, so valid question. So what they should do is, first and foremost, don't take things that, if you are hiring somebody in India, it will not cost you. Hiring somebody will cost a salary, plus it will also cost you the taxes which you have to pay to the government on a certain margin which you will not earn, but you need to show that you have earned. Okay, I'll give an example. Your total cost of operation in India for a GCC is 100 rupees, and if you're under software services, you might have to pay 17%, but don't have to pay 17%. On 17% you have to pay taxes. So take 4%. So on 100, 4 rupees is your taxation. So government calculates that 4%. So all the founders, all the promoters of the company should look at that there is a cost involved for the taxation to be paid in India.
So is that how cross-border invoicing also works, with the same example that you explained?
Exactly. So when you are sending this invoice to your foreign entity, let's say for a parent entity, you have to charge 100 plus 17, 117, and on that 17 you have to pay taxes. So there is a threshold of 5 CR. So if you cross 5 CR, you have to get back that 17 also to India. That's a forex related topic, we can discuss separately, but you have to pay 4% taxes on 100 rupee invoices generated. But charge 17 so that you can get 17 is parked there, and then 4 you pay taxes out of it.
All these founders, the Indian entities are also expanding globally.
Right.
So what is the transfer pricing applicability there?
So see, the transfer pricing for the Indian entities who have a foreign subsidiary, they have to be careful when the audit is happening in India, because they can't do any transactions just like that by saying that I am selling at a losses then. Government will charge taxes to you, because sometimes they don't understand first thing, or sometimes they understand a lot of things and they try and you can say sabotage that income tax, and they say I'm incurring a losses, and actually they are making a profit in a different manner. So to avoid any sorts of unwanted, unlawful transactions, government has imposed a transfer pricing for the Indian entities who are doing business in the foreign countries. So there has to be an arm's length transaction in terms of all the transactions.
So it is both the ways, even if it's a foreign company in India or Indian company in foreign.
Absolutely.
Okay. And What are the penalties if we miss this compliance, sir? Is it very heavy?
No. They have to be very careful. The penalties are extremely heavy. Sometimes even to the directors who are in the local entities have to be, the government can charge 2 times, 3 times penalties for that. They can be imprisoned also. So you need to be very careful that, don't defy the law. Just follow what are the transfer pricing applicabilities and pay the taxes to the government.
Thank you so much, sir. Thank you for your insights on transfer pricing, and we will ensure that no clients of CFO Angle miss this very important compliance that needs to be followed.
Absolutely. And also make sure that you reach out to people in your existing entities, plus whoever comes in, give them a right advice that transfer pricing is important. Do a detailed study about what product and services they want to do business in India, and make sure that give them a right advisory by what percentage is applicable to them.
Yes.
Okay?
Yes.
Thank you very much.
Thank you so much.